Good afternoon, everyone. In today's video, I'm going to focus in on the FOMC volatility and specifically what price action looked like after we had the FOMC statement. This is less about the narrative, not really focused on interest rates or the asset purchase program. What I'm more curious about is what did price action look like? Now we'll focus in on the S&P 500 and the Nasdaq, and the way I've laid this video out is through screenshots to try and go through this step by step so we can see really how price action evolved as the announcement progressed. Now let's get started here with the S&P 500, and if you were looking to try and trade the FOMC event, the bare minimum risk that I think you needed to have in terms of your tolerance was 13.5 points, and this is based off of our doomsday conservative models, or our most conservative model that we have available. Now let's get started here. Initially, once we had the announcement come out, or the statement rather, we had that first spike up, and this is what I think we're used to seeing now, is we have the initial reaction and then we have a fade of that reaction. So that quote unquote model or pattern continued to keep playing itself out here. This is the S&P 500. This is using our second most conservative model here, so we still have one more available, and you'll see I'll switch over to that on the next chart. But starting with the conservative, we had that spike move up, and then we had the sell-off or the reaction happen from that chart. This is again using 3-minute candles. So as at this moment, we have 3, 6, 9, and 12 minutes passed after that 11 a.m. hour, 11 a.m. Eastern. Now, the next chart, you'll see we had the drastic reaction, the sell-off that took place, or that reaction we're used to seeing after that first spike up higher, the move that you can fade. This is off of the doomsday conservative models now. And what you should start to see is we start to build somewhat of a base here. So we have large bearish candle number 2, and then we finally have our first small inside candle where it looks like we're starting to build somewhat of a base. Still on our 3-minute chart, and this is now on our most conservative model. So the cyan line is usually where we look at really starting to enter this trade, and we need to see price stabilize here, and we need to start to see somewhat of a reversal instead of trying to jump the gun. Now the good news here, at least the first sign that a base may be forming, is that next candle isn't another huge bearish red candle going straight outside of the clouds, but instead we're starting to slow down just a little bit. So let's see how price evolves here. Now, the next chart, you can start to see or get an idea rather of the wicks of this chart, which gives you an idea that neither buyers nor sellers have any control, but we also have somewhat of a wedge forming. Both bodies close fairly close to one another, and these two candles are drastically different than what the sell-off two candles the previous 6 minutes have been like inside of the S&P. So let's keep moving forward, see what evolves here. Now I've boiled into a 1-minute time frame chart so you can start to see this in a little bit more granular fashion. But once we had that base really start to build up, we had the wedge, we then broke outside of that base, and we had our first move up higher. Now this wasn't some drastic move of any measure. However, we did see this cyan line give us somewhat of a base in terms of where price action stops in terms of the selling, and where we can start to see a bit of a reversal. We also had our close above our previous high candle with this current green candle. The edge signal then comes in a few minutes later, a little bit later than I think I would have hoped for. So to me, the S&P move wasn't tradable using the edge signals indicator. But for those of you using just purely price action, you did have really that classic base pattern. You had the close above the previous high, and then we had that slight reaction up higher. So inside of the S&P 500, this is what price action ended up looking like using our doomsday conservative models with the FOMC related volatility. Now next up, let's move on to the Nasdaq. Similarly, inside of the Nasdaq here, the risk required was 58 points. Again, that's using the doomsday conservative models. And what is the risk if you entered at the cyan entry line and you had your stop outside of the clouds? So let's keep moving forward here. So back to the Nasdaq, let's go with that first screenshot. This is what the initial reaction looked like inside of the Nasdaq. And the one thing that should stand out here is that initial model we were on. The Nasdaq, we were still contained inside of the aggressive Volatility Box models, which is way over here compared to the S&P, which was way over here to start off the FOMC event. So this gives you an idea that the Nasdaq was this less volatile between the two markets, which is interesting. Usually we see the Nasdaq as the more volatile market. This time around, that wasn't the case. Again, same 3-minute chart. We can see the initial spike up. Now what we should see after is the reaction after that, which inside of the Nasdaq, we hit our doomsday aggressive models. So this is that short side opportunity. Again, if you did take this, his stop is outside of your clouds. we have the close below the actual candle's low, the previous candle's low. So this is what starts to confirm that potential move down. Keep taking a look forward. Now we have that sell-off where I also caught that minus 1,000 tick reading on that screenshot. So this gives you an idea of just how much selling there was in the FOMC event. So once we tagged the upper bound, now I've switched over to our last and final most conservative model, the doomsday conservative model. This is where that 58-point risk is required. That's really the distance between the cyan line and the outer edge of the cloud. So that's the 58 points, and that's where that risk comes from. Now here in the Nasdaq, we're starting to see that same 6-minute sell-off activity with that perpetual tick reading below 1,000. We need to see price action stop here and have somewhat of a base. If we continue to keep going straight through the clouds, then you know that, hey, the selling pressure inside of the Nasdaq is way too much. No real entry here. There's no base forming at all. It's really just all sell side activity. Instead, what we saw, very similar to the S&P, bit of a base forming here. Wick starting to get a little bit narrower. We're starting to see somewhat of a wedge. The bodies are fairly close to one another, but the wicks are much, much larger on both sides, not just the buying side, not just the selling side. So lack of clarity there. Now keep moving forward here. Switch over to that 1-minute time frame chart. Very similar to the S&P, that first green candle where we close above that previous high is that breakout candle, if you will, the one that confirms this low. Now after that candle, we chop around a bit more before we finally see the edge signal and see price action starting to get going. Now the reason I have screenshots here is so you could see how that move progressed during the actual FOMC announcement. Let me now show you how that move looked like as the hour progressed after that initial spike up higher. So let's start first with the S&P. This is where we saw that spike up. Then we had price action come right back in. We bounced one more time from the same cyan lines before ultimately price action just continued back into its sell-off mode, really obliterating all of our models. And at that point, once we go outside of the clouds, this is the end of trading inside of the S&P for us. Similarly here inside of the Nasdaq, if we take a look, we had the initial reaction, then we had the retest one more time at the cyan lines, another bounce. Can't really get much higher than this range that we've now started to trade inside of before the Nasdaq also continues selling off. And we see very persistent minus 1,000 tick readings before eventually as the market closed, that reversed to some plus 1,000 tick readings as well. So definitely an interesting day in terms of the FOMC related volatility. Leading up to the actual event, you can see a little bit more muted. However, once the event actually came into play, very much a volatile event that, in my opinion, was tradable, but required substantial risk involved per each trade. 58 points on the Nasdaq, 13.5, 14-ish points on the S&P 500. So this wasn't for the faint of heart. This definitely required enough risk. This definitely required either using micros or larger accounts. And it definitely still required being able to take your losses as soon as the market told you that you were wrong. But hopefully this event and this walkthrough helps give you an idea of what volatility looked like as the FOMC event progressed and as we saw each candle unfold itself. All right, hope this video is helpful. Take care, everyone. Good luck trading, and we'll see you in the next update.